After one heck of a year full of market uncertainties, bullish tech runs, and of course market plunges all along the way, 2023 has officially come to its end, finishing much stronger than we all would have thought, with the S&P soaring by over 25%. But let me be the first now to welcome you to 2024. Happy New Year, but don't get too comfortable, because I really think we're in for quite an interesting ride in the year ahead. Therefore, today, I want to quickly cover some of our 2024 need-to-know macros, then dive right into 7 dividend stocks to kick off your year with dividends and passive income all in mind. With that, let's go ahead and dive right in. So here we are with a brand new year ahead of us, and hopefully with the same goal in mind, yet with strengthened ambitions to perfect our dividend investing strategies to ultimately achieve financial freedom much earlier than expected. And to do so, it will surely require your head in the game. The macro game, that is, because I truly believe we're in for it in 2024. Why? Well, the overall market environment could get quite uncertain, and in that uncertainty, there's always volatility. Now, I'm bullish on one end because the Federal Reserve, as they've shared and also as they've already illustrated, is very likely to become more dovish and will eventually begin to lower interest rates.
As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully.
This will drive the market to some higher highs and I think give way to a bull run. On the other hand, when we look into some, say, less flashier sectors like consumer staples, industrials, or the healthcare sector and the alike, we see a multitude of stocks that are trading right now at historically reasonable valuations, which may be advantageous to investors like us looking to capitalize on what could be a blaze of uncertainty from expensive growth stocks, an interest rate pivot, and just continued unwinding of pandemic-era stimulus. Either way, just know the ticket to the rodeo with the bulls off to the races will commence the moment Powell makes his chess move to actually reverse course on interest rates. Now, as for the dividend stock picks of the day, the first 3 are going to revolve more around income and safety before bucking into more dividend growth-oriented stocks. So first up, Amcor, ticker symbol AMCR, which is a global packaging company that develops flexible packaging and more of our everyday rigid containers while also packaging medical devices as well as providing the packaging for some of our home and personal care products. Literally nothing sexy about this company, but a company that remains a necessity, if you will, in our everyday lives. So you can imagine it doesn't experience much growth, but it does falter when external macro factors shift consumer trends, which is why right now we have it trading for just $9.72 per share at a P ratio of 14.7. Zooming out to a decade's time, we see only 5% worth of growth. So again, you won't get much out of it in terms of growth other than the passive income factor, which will be nice for you to buy it then in the red territory like it is right now. And when you do, Amcor will reward you with their 5.14% dividend yield, which again isn't going to grow much and remains with an untouched dividend streak for 40 years, growing on average by just about 2% over the last 20 years. Now, many investors shy away from Amcor because of such low growth. So I'm happy to then share a very safe pick with you that actually does gift you with some more growth. We have Kimberly-Clark, ticker symbol KMB, which is in the business of manufacturing tissue, papers, and hygiene products. Now, it's estimated, check this out here, that roughly 25% of our world consumes Kimberly-Clark products. So that moat is certainly there for you as an investor. And when it falters, like right now, down 8% on the year, trading for just $120 per share, we see certainly time and time again that there's just steady growth here with Kimberly-Clark, at least 66% over the last decade. And if we check in with the analysts, we see nominal growth projections as well, coming up to $124.64 per share in the near term, but it appears that hedge fund activity is also starting up as well, with smart money buying into Kimberly-Clark last quarter. But invest into Kimberly-Clark for the dividends because we have a yield coming in at 3.92%, whereas we find Kimberly-Clark with 88 years worth of uninterrupted dividends at a 7% growth rate over the last 20 years. Now, just before we actually jump out of the consumer staples sector, I want to go ahead and bring your attention over to a dominant player in the industry, Procter & Gamble, ticker symbol PG, which is an industry juggernaut in my opinion, with dozens of brands that I would imagine you're using every single day, whether it's for the little ones with Love's diapers or Pampers, laundry with Tide, Downy, or Gain, or when it comes to personal care products like their Gillette products, Old Spice products, or Venus products. Now, it will be a blue moon before Procter & Gamble actually becomes undervalued, but in my book, that's worth your investment then at a fair price. Right now, it's off its peak of $157 per share, trading for $146 per share at a PE ratio of 23.7. Zooming out to the last decade, we get over 139% worth of share price appreciation. Now, in my opinion here, along with the analysts, there's going to be growth. Analysts are forecasting 12% worth of it, climbing up to $163.67 per share. We got smart money moves all over this one with 4.8 million shares purchased last quarter. And if you're looking for an incredibly safe dividend player, we have it here with Procter & Gamble with a dividend safety score of 99 on Simply Safe Dividends, as their dividend yield is currently at 2.58%. That has been time tested with uninterrupted dividends for over 133 years, but more importantly, growth here on average 8% over the last 20 years. Now, investors, we have 4 more dividend stocks to go, obviously. But before we actually cover them, if you're getting value from this video, why don't you go ahead and tap on that thumbs up button for me and let me know for the year ahead so I can continue to make content just like this, and I know it's the content that you actually like consuming. With that, let's get back to it here with General Mills, ticker symbol GIS, a manufacturer and marketer of brands of consumer foods, with Cinnamon Toast Crunch, Chex Mix, and Haagen-Dazs being my personal top 3 among their 100 plus brands. Definitely let me know your favorite brands of theirs in the comments down below, but certainly a company that will ebb and flow with consumer trend shifts. And after a year like we just had, wowzers, we are down now here by 20% on the year, trading for just $64 per share at a PE ratio of 15.7, presenting an opportunity especially after 81% worth of share price appreciation over the last decade. Not to mention analysts forecasting yet more growth coming up to $67.91 per share, as it appears hedge funds are also beginning to actually go ahead and buy in, from Caxton Associates to Echo Street Capital. But now, more importantly for you and me as dividend investors, the dividend insights. Favorable insights coming in at 3.65% worth of a dividend yield that's been paid out without interruptions for over 125 years, with roughly 7% worth of growth over the last 20 years alone. Next up, if you're actually looking for what I would call quite a turnaround play, I've been touting Tyson Foods, ticker symbol TSN, for quite some time now, which is one of the world's largest producer of beef, chicken, and pork. Definitely the largest producer within the United States, but nonetheless crushed by our macro environment after animal feed costs skyrocketed, along with transit fees, to which the stock itself fell, now down by 12% on the year, trading for $52 per share. Yet in regards to Tyson, given their management mishaps, we'll call them, all year long, it will really require not only a macro adjustment, but internal work as well, which I do believe Tyson is actually capable of pulling off, so just give this one some time. After all, quite a history worth of doing so, with over 91% worth of appreciation over the last decade, and get this, a very sharp increase in hedge fund activity here. But until that turnaround, you're going to be able to beef up your portfolio with a very mouth-watering 3.71% dividend yield that has been steadily shelled out for the last 32 years, while growing up to 13% on average over the last 20 years. Now, if you're really looking to, say, supercharge your dividend portfolio with a dividend stock, you can find some sparks with American Electric Power, ticker symbol AEP, which is a utility holding company with approximately 5.5 million customers across 11 states, making it actually one of the largest utility companies in the United States, and granting investors with a sense of safety as well, because we all know that utility plays are very safe. But we do have a stock right now at $80 per share that's down by roughly 11% on the year, with a PE at 18.6. Do you want to zoom out here with you to see over 146% worth of appreciation over the last decade, while analysts are still projecting upside, roughly 8.45% worth of it coming up to $87.64 per share. Not to mention, we have a boatload of hedge funds scoring more shares, more than 887 shares last quarter, allowing them to receive the American Electric dividend, as it comes in with a 4.36% dividend yield, remaining safe with a payout ratio at 66%, and shelling out dividends uninterrupted for the last 18 years. Next up, after quite a low-flying year for United Parcel Service, ticker symbol UPS, the world's leader in logistics, which actually dipped by over 6% on the year, trading now for $156 per share with a PE ratio at just 16, we have yet another serious turnaround player on our hands when consumer trends shift and businesses get back to, well, business as usual, especially when it comes to the e-commerce space, space picking back up, which will lead to really UPS soaring once again. We already see 103+% worth of appreciation over the last decade, and analysts right now that are predicting the share price to rise back to $170 per share, all while hedge funds have already begun loading up on UPS with over 5.6 million shares purchased last quarter. But simply holding on to UPS for the long term is what you're going to want to do, as it rewards you lucratively thanks to their 4.13% dividend yield that's gone uninterrupted for the last 24 years, all while growing by about 11% on average for the last 20 years. And there you have it, 7 dividend stocks to kick off your 2024. Drop your thoughts down in the comments below. Subscribe if you haven't already, because it's going to be one heck of a year you're not going to want to miss out on as a dividend investor. Catch more insights right here, or of course, just come back for more.